Welcome to Wealth and Means, advice dressed up like hard work. Thank you to our new listeners from Albania, Argentina, Bolivia, Brazil, Canada, Ecuador, Egypt, Iraq, Malaysia, Nigeria, Syria, South Africa, the United States, and Vietnam. Let's get into it.
This week, something strange happened in a physics lab in Bangalore. Electrons started behaving like water, frictionless, collective, breaking a rule that's held for over a century. And halfway around the world, a solar cell lab in Austria found something equally strange. The flaws in their materials weren't a problem. They were the whole point. That's the thread this week. Imperfections doing the heavy lifting. From solar cells that work better because they're broken, to gray whales swimming into a city bay that's quietly killing them, to an oil market that dropped 11% on a single sentence from Tehran. The pattern keeps showing up. What looks like a defect turns out to be a signal. What looks stable turns out to be fragile. We've got a full radar this week, 12 stories you didn't see leading the headlines but should have. A macro weather report for the week ahead, and it's a big one, with the Fed meeting on deck, earnings season heating up, and a yen that's inches from an intervention zone. A knowledge bomb on yield maxing, the real math behind BDCs, preferred share funds, MLPs, and those private debt offers flooding your inbox. The greater debate that puts Frederick Taylor's hard skills gospel against Daniel Goleman's emotional intelligence research and asks which one actually builds a career. And we'll close with the story of a man who built the device that made every other measurement trustworthy and then gave it away for free. Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. First, let's begin with what you didn't see in the news. Let's start with something that sounds like it shouldn't be true. Scientists in Bangalore and Tsukuba just watched electrons in graphene flow like water. Not metaphorically, literally. They measured it. A team at the Indian Institute of Science, working with Japan's National Institute for Materials Science, created ultra-clean graphene samples and found that near the Dirac point, that's the sweet spot where the material's unique physics kick in, electrons stop behaving like individual particles bouncing around. They form a collective fluid, a nearly frictionless one. The team measured its viscosity, and it's one of the lowest ever recorded for any fluid in any system. Here's where it gets wild. This Dirac fluid mimics something called a quark-gluon plasma, a state of matter that usually only exists inside particle accelerators at CERN. And it violates the Wiedemann-Franz law, a foundational rule in physics that says heat conduction and electrical conduction in metals should be proportional. The deviation they measured wasn't subtle. It was 200 times the expected value. According to Science Daily, the researchers believe this state could enable a new generation of quantum sensors capable of detecting electrical signals and magnetic fields that current instruments can't touch. The paper dropped April 15th, and it's already reshaping how condensed matter physicists think about transport in two-dimensional materials.
200 times. That's not a deviation. That's a different universe wearing the same outfit.
From the very small to the very large, and from a broken physics law to a broken migration pattern. Gray whales are swimming into San Francisco Bay, and nearly 1 in 5 of them are dying there. A study published this month in Frontiers in Marine Science tracked 114 individual gray whales that entered the bay between 2018 and 2025. Researchers matched 21 of them to recovered carcasses, an 18% mortality rate inside a single urban waterway. Necropsies on 30 of those carcasses showed blunt force trauma consistent with vessel strikes. These aren't lost whales, they're hungry ones. Climate change is disrupting the Arctic food web that gray whales depend on. As sea ice melts earlier each year, phytoplankton bloom before they can sink to the seafloor, which means the benthic invertebrates that whales actually eat don't get fed. So the whales are improvising. They're entering bays and estuaries they've historically avoided, searching for alternative food in waters crowded with container ships and ferry traffic. According to NOAA, the eastern North Pacific gray whale population has dropped more than 50% since 2016. San Francisco Bay isn't a refuge. It's a trap disguised as one. And the whales don't know that until it's too late.
50% population decline in a decade. That's not a trend. That's a collapse wearing a migration pattern.
Now, here's where that privacy anxiety that's been building all year is translating into measurable action, and it's showing up in the search data. Vault Warden, a self-hosted open-source password manager, just hit breakout status on Google Trends. That's Google's designation for a search term that surged more than 5,000%. It's not alone. Gitea, a self-hosted Git platform, is up 300%. AppFlowy, an open-source Notion alternative, is up 130%. The de-Googling subreddit has crossed 400,000 members. What's driving it isn't ideology, it's a series of concrete betrayals. The Electronic Freedom Frontier's recent complaints about tech companies sharing user data with law enforcement without notification, cloud storage breaches, and the broader realization that cloud promises have conditions. Self-hosting used to be a sysadmin hobby. Now it's a Docker install and a weekend project. According to dev.to, the self-hosted software movement has grown 40% since 2023, with GDPR compliance and what analysts are calling cloud fatigue as the primary accelerators. Vault Warden alone has 35,000 GitHub stars and runs on under 50 megabytes of RAM. A family of 6 saves $40 a year. A small team saves nearly $500. The math isn't theoretical anymore. It's on people's kitchen tables, running on Raspberry Pis.
400,000 people didn't join a subreddit because they love server racks. They joined because they stopped trusting someone else's.
That same instinct, who do you actually trust, is reshaping a $32.6 billion industry. The influencer marketing economy hit that number in 2026, and the fastest growing slice isn't celebrities or mega influencers. It's micro-influencers, creators with 10,000 to 100,000 followers, and the data explains why. According to Creator IQ, micro-influencers generate an average engagement rate of 3.86%. Mega-influencers? 1.21. The cost per post is 60% lower. And here's the number that matters most. Consumer trust in micro-influencers sits at 82%. That's not a marketing stat. That's a behavioral signal. 92% of marketers say they'll work with micro-influencers in 2026, up from around 70% 2 years ago. The structural shift is straightforward. Audiences are gravitating toward creators who feel familiar and relatable, what the industry's now calling comfort creators. A recommendation from someone you watch daily lands differently than a celebrity endorsement. It lands like a friend's suggestion, and that trust converts. The entire advertising model is tilting from reach to resonance, from impressions to intimacy. It's not a trend, it's a repricing of attention.
82% trust. That's higher than most people's trust in their own financial advisor.
Speaking of trust and financial signals, let's talk about what happened on the New York Stock Exchange this week. Madison Air Solutions went public on April 16th, and it wasn't a quiet debut. The company priced 82.7 million shares at $27 each, raising $2.23 billion. That makes it the largest U.S. industrial IPO since United Parcel Service raised $5.5 billion in 1999. Shares jumped 18.5% on day one, giving Madison Air a valuation of $15.7 billion. Now, what is Madison Air? It's a Chicago-based maker of ventilation and filtration systems, HVAC. Not exactly the stuff of IPO fantasies, until you realize that 66% of its revenue comes from commercial clients, and a growing share of those clients are building data centers. The air that cools your AI workloads doesn't cool itself. Madison Air generated $433 million in revenue last year, up 10%, and the market's betting that commercial ventilation is a secular growth story hiding inside a boring industrial wrapper. According to Bloomberg, it's the clearest sign yet that the IPO market isn't just open, it's rewarding companies with real revenue and a structural tailwind.
The most valuable company to go public this week makes air ducts. Let that land for a second.
And it wasn't the only major listing. On the same day Madison Air debuted, AEVEX Aerospace priced its own IPO at $20 a share, raising $320 million. AEVEX builds military drones, specifically airborne intelligence, surveillance, and reconnaissance platforms, and its portfolio now includes unmanned systems capable of strike missions with guided payload delivery. Revenue hit $433 million last year, up 10%, with net losses narrowing sharply from $78.6 million to $16.8 million. The timing isn't accidental. According to Bloomberg, defense tech IPOs are riding a wave of increased spending driven directly by the Middle East conflict. AVEX's client base is the U.S. government and allied forces, and the demand signal from the ongoing Iran war is translating into investor appetite. Goldman Sachs, Bank of America, and Jefferies led the book. The broader pattern here is that two industrial defense IPOs pricing in the same week, both oversubscribed, both popping on debut. That's not a coincidence. It's a capital market telling you where it thinks structural demand lives for the next decade.
Ventilation systems and surveillance drones pricing the same week. The economy's shopping list just got very specific.
Now let's talk about the business that's bigger than all of those IPOs combined. The NFL and YouTube have entered what NBC Sports is calling a long-form contract review for a 5-game exclusive streaming package in 2026. That means the major terms are agreed and lawyers are hammering out the language. This isn't YouTube's first NFL play. They signed a 7-year, $2 billion deal for Sunday Ticket in 2023. But this is different. These are 5 standalone regular season games that won't air on traditional television at all. You'll need a YouTube subscription to watch them, and it's part of a much bigger shift. The NFL's total media rights package is projected to jump from $10.1 billion to $15.9 billion annually. According to the Los Angeles Times, that number is so large, it's reshaping Hollywood's entire budget calculus. Networks that pay more for football have less to spend on scripted series, limited runs, and film development. The NFL isn't competing with other sports anymore. It's competing with Netflix originals and theatrical releases for the same production dollar. Netflix and Fox were also in the running for this 5-game package. YouTube won because it can offer something traditional networks can't: a global audience already on the platform, plus the data infrastructure to personalize the viewing experience. 5 games might sound small. It's not. It's the proof of concept for NFL content leaving broadcast entirely.
The NFL's TV deal is now bigger than most countries' film industries, and 5 games just moved to a platform that didn't exist when the last CBA was signed.
Now let's cross the Atlantic and head south. On May 1st, less than 2 weeks from now, the EU-Mercosur trade agreement begins provisional application. This is the world's largest free trade area coming to life. All 4 founding Mercosur members, Argentina, Brazil, Uruguay, and Paraguay, completed ratification by March 17th. The EU Council formally endorsed the deal in January, and it was signed on the 17th of that month. Tariffs on certain products start dropping from day one. According to Euronews, the deal covers a combined market of over 750 million people and will reshape trade flows across agriculture, manufacturing, and services. But it's not clean. The European Parliament voted in January, 334 to 324, to ask the European Court of Justice whether provisional application is even legal before all 27 EU member states ratify individually. That legal challenge is still pending, and Brussels isn't just looking south. It's accelerating trade talks with Canada, Japan, and South Korea, partly as a hedge against ongoing U.S. tariff volatility. The strategic context here is unmistakable. Europe is building trade architecture, while Washington is still sorting out Section 122 replacement tariffs. The EU-Mercosur deal isn't just a trade agreement. It's a geopolitical statement about who's building long-term partnerships and who's issuing 150-day decrees.
750 million people in a trade zone that goes live in 2 weeks. And most Americans haven't heard of it.
Which brings us to the energy story that moved everything on Friday. Iran's Foreign Minister Abbas Araghchi declared that the Strait of Hormuz, the choke point for roughly 20% of the world's oil, is open for all commercial shipping. The announcement came in connection with the Israel-Lebanon ceasefire that took effect April 17th. Oil prices didn't walk down, they collapsed. U.S. crude fell 11.4% to $83.85 a barrel, its lowest since March 10th. Brent dropped 9% to $90.38. Heating oil futures, a proxy for jet fuel, fell 10%. Wholesale gasoline futures dropped 5%, and analysts are now projecting the national average could fall below $4 a gallon within days, possibly reaching $3.65 to $3.85. But here's the tension. President Trump immediately responded that the U.S. naval blockade on Iranian ports continues. The blockade isn't about the strait. It's about vessels docking at or departing from Iranian ports specifically. So the strait may be open, but Iranian oil still isn't flowing freely. According to CNBC, crude is still above its pre-war $70 level, which means the market's pricing in continued uncertainty even as the headline screams relief. One sentence from Tehran moved 11%. That's how tight the spring was wound.
An 11% move on a sentence. The market wasn't trading oil, it was trading hope.
Now to a story that's quieter, but might matter more to your family than any of the above. Researchers at the German Center for Neurodegenerative Diseases just published findings in Nature Communications showing that the brain's immune cells, microglia, actively destroy nerve fibers connected to your sense of smell, and they do it years before any cognitive decline shows up. The mechanism is specific. Neurons in the olfactory bulb develop surface changes, essentially an eat-me signal, that trigger the microglia to dismantle them. This isn't correlation, it's causation, observed in mice, confirmed in human tissue, and validated with PET scans. The clinical significance is enormous. Alzheimer's drugs like amyloid beta antibodies work best in early stages, but by the time memory symptoms appear, significant damage has already occurred. If smell loss can be reliably detected and linked to this immune process, it opens a diagnostic window that doesn't currently exist. According to Science Daily, the research suggests that a simple smell test could eventually become a frontline screening tool, not replacing brain scans, but preceding them. The team's work connects a symptom most people dismiss, I can't smell things as well as I used to a molecular process that predicts the disease.
A smell test that catches Alzheimer's before you forget your keys. That's the kind of early warning the world needs.
From biology to materials science, and another case of imperfections doing the real work. Researchers at the Institute of Science and Technology Austria published in Nature Communications this month showing that structural defects inside perovskite solar cells don't hurt performance. They help it. The team found that naturally occurring networks of these defects create pathways that separate and guide electrical charges over long distances, which is exactly what you need for efficient energy conversion. Here's why this matters. Silicon solar cells depend on near-perfect crystal purity to function. That purity is expensive and energy-intensive to achieve. Perovskites, by contrast, are cheap, flexible, and now, according to this research, actually benefit from their imperfections. It's a paradigm inversion. In a parallel development, Halocell Energy announced that integrating advanced metal oxide nanoparticle layers into perovskite modules maintained nearly 100% efficiency after 1,300 hours of accelerated stress testing. That's the durability gap closing. If perovskites can be both efficient because of their flaws and durable because of new coatings, the economics of solar shift dramatically. The installed cost of silicon has been the moat. This research suggests the moat has a crack, and the crack is a feature.
Solar cells that work better because they're broken. If that's not a metaphor for this entire episode, I don't know what is.
Let's close out the radar with a currency story that's heating up faster than most people realize. The Japanese yen is threatening to break above 160 against the dollar, a level that historically brings direct intervention from Japanese authorities. Finance Minister Katayama told G7 members this week that Japan is watching foreign exchange markets with what she called a high sense of urgency. That language matters. It's the verbal playbook that precedes actual intervention. According to MUFG research, the yen's been the second worst performing G10 currency since the US-Iran ceasefire was announced on April 7th, even as the dollar itself has weakened. The reason? The Bank of Japan keeps delaying rate hikes. Governor Ueda provided no clear signal on timing after the latest meeting, and the Japanese rate market is now pricing in just 5 basis points of hikes, essentially nothing. By holding rates steady while the yen weakens, the BOJ is forcing the government's hand. If you're watching global macro, this is the quiet trade. Japan either intervenes to support the yen, spending reserves and creating friction with the US, or lets the currency slide further, which feeds import inflation and erodes consumer purchasing power. There's no clean exit, and with the FOMC meeting next week, any hawkish signal from the Fed makes the yen's position even more precarious. Now let's wake up ready. The headline event is the FOMC meeting April 28th and 29th. The decision drops at 2 p.m. Eastern on the 29th. Here's what to watch specifically. The market's currently pricing in the Fed funds rate holding at 3.75%, with roughly 62% probability of one cut by July. That's the baseline. The question isn't whether they cut, it's what language changes in the statement. Watch for any shift in how the committee describes financial conditions. specifically whether they upgrade from broadly appropriate to something that acknowledges the war premium in energy prices feeding into core services inflation. If you see dissent from Waller or Bowman on the pace of future cuts, that's the tell. It means March's statement was a negotiated compromise, not a consensus. And if it was a compromise, the path to a July cut narrows. The second-order consequence: if the statement tilts even slightly hawkish, watch the 2-year Treasury yield. It's been trading around 4.1%. A move above 4.25 reprices rate-sensitive sectors: housing, small-cap growth, and anything levered to cheap short-term financing.
The Fed's not the event. The language inside the Fed is the event. Read the footnotes, not the headline.
Earnings season is accelerating. Capital One reports Tuesday, April 21st, after the close. The signal here isn't top-line revenue, it's net charge-offs and delinquency rates in the consumer credit portfolio. Capital One is the canary for the subprime consumer. If charge-offs tick above 5.5%, that's a deterioration signal for the entire consumer lending complex. The market's pricing Capital One at roughly 14 times forward earnings, which implies modest credit normalization, not acceleration. A miss on credit quality reprices not just Capital One, but Synchrony, Discover, and the broader consumer discretionary sector, because it means the lower-income consumer is cracking faster than the job market suggests.
Capital One isn't reporting earnings. It's reporting on the American wallet. Listen accordingly.
Halliburton also reports Tuesday morning. This one's directly tied to the energy story we just covered. The question isn't whether North American drilling activity held up, it's what management says about international orders, specifically Middle East contracts. If Halliburton's international backlog is growing despite the war, that's a signal that the defense energy complex is structuring around prolonged conflict. If it's softening, the ceasefire optimism in oil prices may be better founded than the skeptics think. The market's got Halliburton priced at about 11 times earnings, below its 5-year average of 13, which means the bar is low. A beat here moves the oilfield services group, and it moves it fast. Watch what they say about capital discipline versus growth spending. That's the tell on whether operators believe oil stays above 80.
Halliburton's guidance is a proxy for how long the world thinks this war lasts. Price it accordingly.
On the IPO front, National Healthcare Properties is expected to price the week of April 20th. It's filing for up to $616 million at $13 to $16 a share, which puts the valuation at around $1.1 billion. This is a senior housing and outpatient medical REIT with 37 communities and 130 facilities. The thesis is straightforward. Baby boomers are aging, occupancy rates in senior housing are climbing, and healthcare real estate is a defensive play in a market that just ran to all-time highs. Wells Fargo, Morgan Stanley, and BMO are leading. The second-order play here: if NHP prices well, watch the broader healthcare REIT complex, Welltower, Ventas, Sabra, because it validates the aging demographics trade at a moment when the market's otherwise chasing growth. If it prices wide or struggles, it signals that defensive capital isn't as hungry as the demographic story suggests.
A senior housing REIT pricing into record highs. The question is whether the market wants defense or growth, and right now it's trying to buy both.
2 more things to watch. First, the EU-Mercosur provisional application date is May 1st. That's 12 days away. Any legal challenge from the European Court of Justice between now and then could delay implementation. If it doesn't materialize, you've got the world's largest free trade zone going live, and the immediate beneficiaries are European agricultural importers and Brazilian commodity exporters. Check soybean and beef futures the last week of April. That's where the trade reprices first. Second, and this is my personal pick for the week, watch the Japanese yen around the FOMC decision. If the Fed statement tilts even slightly hawkish, the dollar strengthens, and US JPY pushes past 160. That's the intervention zone. Japan's finance minister has already used the verbal playbook. If we see actual dollar-selling intervention from the MOF, it creates a short-term yen rally. But more importantly, it signals to global macro traders that BOJ government coordination has broken down. That's a structural story, not a one-day trade. The carry trade unwind from a surprise intervention could ripple through emerging market currencies within 48 hours.
And that is how you wake up ready. Let's talk about something that's been showing up in a lot of inboxes lately: yield. Specifically, the race to maximize it. BDCs, preferred share funds, MLPs, private debt platforms, They're all promising fat distributions, and they're all getting more retail attention than they've had in years. So let's break down what you're actually buying when you chase each one. It's time for the knowledge bomb. Start with BDCs, business development companies. These are publicly traded firms that lend to middle market companies, typically ones too small for the bond market and too large for a bank line of credit. They're legally required to distribute at least 90% of taxable income, which is why yields run between 8 and 13% right now. The MVIS US BDC index is yielding 11.3% as of mid-April, nearly double high-yield bonds. Sounds great, but here's the catch. BDC loans are mostly floating rate, and the Fed's already cut 3 times since October 2025, bringing the funds rate to 3.75. Every cut compresses the spread BDCs earn on their loans. Analysts are projecting a modest trim, maybe 10% in BDC dividends through 2026. And the credit picture isn't pristine. Non-accrual investments have crept up to a median of 2.5% of total investments at cost. The BZD ETF's 9.3% yield is masking credit stress building underneath. BDCs aren't bad instruments, but they're not savings accounts either. You're making a credit bet on middle market companies, and you're doing it with leverage. Now, preferred share funds. These sit between bonds and common stock on the capital structure. They pay a fixed dividend. They have priority over common equity in a liquidation, and they don't usually have voting rights. Yields typically run between 5 and 7%, lower than BDCs, but with significantly less credit risk. The trade-off is interest rate sensitivity. Preferreds behave like long-duration bonds. When rates rise, their prices fall, and they've taken meaningful hits in rising rate environments. If you think the Fed's done cutting and rates stabilize or drift higher, preferreds get caught in the crossfire. The sweet spot for preferred funds is a flat to falling rate environment with stable credit, which is exactly what the market was pricing in January before the war repriced inflation expectations upward. Right now, preferreds are a bet on rates staying stable. If you're wrong about the direction of rates, you can lose your yield and your principal. MLPs, Master Limited Partnerships. These are pipeline and energy infrastructure companies structured to pass income through to investors without paying corporate tax. Yields run anywhere from 5 to over 10%. The structural advantage is tax deferral. MLP distributions are often classified as return of capital, which reduces your cost basis and defers the tax bill until you sell. The downside, MLPs issue K-1 tax forms, which are complex, sometimes delayed, and can create complications if held in tax-advantaged accounts. And here's the risk nobody talks about enough. MLP revenue is tied to energy throughput volumes. If the war ends and oil demand patterns normalize, pipeline volumes could shift. If there's a recession, industrial and utility volumes fall. You're buying yield, but you're also buying a levered bet on energy infrastructure utilization. That's fine if you know it, less fine if you think you're buying a bond. And then there's the newest entrant, private debt platforms. These are fintech-adjacent offerings that let retail investors participate in private lending, real estate bridge loans, revenue-based financing, even direct SMB lending. Yields advertised range from 8 to 14%, but these are illiquid, often poorly disclosed, and don't have the regulatory scaffolding of BDCs or MLPs. The biggest risk isn't the yield, it's the exit. Many of these platforms have lockup periods, limited secondary markets, and redemption gates that activate exactly when you most want your money back. Some platforms are well run. Others are structured like private funds, but marketed like savings products. The diligence burden falls entirely on you. So here's the yield maxing cheat sheet. BDCs, highest yield, highest credit risk, floating rate exposure cutting both ways. Preferreds, moderate yield, interest rate risk, capital structure protection. MLPs, tax advantage yield, energy volume exposure, K-1 complexity. Private debt platforms, highest advertised yield, lowest liquidity, least regulatory oversight. The question isn't which one yields the most. It's which risk you understand well enough to hold when the market stops being generous. Yield maxing isn't a strategy. It's a temperature reading of your own risk tolerance. And the best yield in the world doesn't matter if you can't sit through the drawdown that comes with it. And that's the knowledge bomb.
Okay, I need to settle something that's been bothering me. Which speculative mania was crazier, tulips or NFTs? Humor me, because I've been thinking about this, and the comparisons are almost too perfect. In both cases, you had a group of otherwise rational adults paying absurd prices for something whose intrinsic value was, let's say, debatable. You had social contagion. You had the greater fool theory operating at full throttle. Nobody was buying because they thought the thing was worth the price. They were buying because they were sure someone dumber would pay more tomorrow. Let's start with tulips. Dutch Republic, 1636. The economy's booming, the golden age is in full swing, and suddenly everyone decides that rare tulip bulbs, specifically broken varieties with these beautiful viral striping patterns, which, by the way, were literally caused by a virus, are the must-have asset. At the peak, a single Semper Augustus bulb reportedly traded for the equivalent of a luxury Amsterdam townhouse. We're talking 5,000 to 10,000 guilders, years of a skilled worker's wages. Contracts for future bulbs were flipping multiple times a day without anyone ever touching an actual flower. And then February 1637 hit. An auction failed, buyers vanished, the market collapsed in about 2 weeks. Now, NFTs. 2021. Beeple sells a digital collage at Christie's for $69 million. Jack Dorsey's first tweet, 5 words, no punctuation, goes for $2.9 million. Bored Ape Yacht Club members are on late-night television explaining why a JPEG of a cartoon monkey is worth more than a house. Total NFT trading volume hit $25 billion in 2021. Monthly peaks topped $17 billion in early 2022. Then the music stopped. Prices dropped 97%. That Dorsey tweet? Last offered for resale at $6,800. Art NFT volume dropped from $2.9 billion to about $24 million by early 2025. That's a 99.2% decline. At least with tulips, when the bubble burst, you could plant the bulb and maybe get a nice garden out of it. With NFTs, you got a receipt on a blockchain pointing to a URL that might or might not still host a picture of a monkey wearing sunglasses. Here's what I'll give the tulip maniacs, though. Modern historians, Anne Goldgar's done the best work on this, argue that the popular narrative is wildly exaggerated. Most of the extreme stories came from satirical English pamphlets mocking the Dutch. There weren't widespread bankruptcies. It was mostly wealthy traders in a few cities playing a futures game during a plague winter when they had nothing better to do. It was a market glitch, not an economic catastrophe. NFTs? No such defense. Millions of people participated globally, egged on by celebrities, influencers, and Discord communities running 24/7 hype cycles. The infrastructure was slicker. Blockchain wallets, instant transactions, global reach, but the psychology was identical. Scarcity plus hype plus leverage equals tears. So which one was crazier? I'm giving it to NFTs. Not because the relative prices were higher, they probably weren't, adjusted for era, but because in 2021, we had 400 years of bubble history to learn from. We had tulip mania as literally the textbook example of speculative insanity, and we did the exact same thing anyway, except this time, instead of a flower, we got a JPEG. At least the Dutch got a garden. We got an Ethereum gas fee and eternal regret. The lesson? This time it's different, is the most expensive sentence in financial history. It's never different. The asset changes, the technology changes, the human brain, same firmware since 1637.
There are debates that stop your reel, and there are the debates that linger long after the dinner plates are cleared. It's time for the greater debate. Imagine a room, 2 lecterns, a room that feels more like a factory floor than a lecture hall, exposed beams, a whiteboard with half-erased diagrams, and the faint hum of fluorescent lights overhead, the kind of space where ideas get tested, not presented. One side is neat, measured, engineered. The other has a coffee ring on the podium and a stack of dog-eared journals. The audience doesn't know it yet, Matt. But they're about to hear 2 people argue about the same workplace while describing completely different worlds. Frederick Taylor steps forward first. He doesn't open with a theory. He opens with a shovel. In 1899, I stood in a steel yard in Bethlehem, Pennsylvania, and watched 45 men load pig iron onto rail cars. They moved 12.5 tons per man per day. I studied the work, the grip, the angle, the rest intervals, the load per carry. I redesigned the process. One man, following my method, moved 47.5 tons per day, nearly 4 times the output. Same man, same shovel, different system. He pauses, lets the number sit. That's what hard skills are. They're the system. They're the thing that turns effort into output. You can have all the empathy in the world, but if you don't know how to measure what you're doing, you're just being kind while being unproductive. The modern workplace runs on data analysis, programming, financial modeling, engineering, logistics. These aren't optional. They're the load-bearing walls. Everything else is decoration. A few nods in the front row. The engineers feel seen. Daniel Goleman doesn't move to the lectern. He steps to the side of it, leaning against the edge, arms crossed. When he speaks, his voice is quieter, not softer, just more deliberate. I don't disagree with the shovel. The shovel works. But let me ask a question. Fred's method doesn't answer. Why did only one man out of 45 agree to do it his way? That lands. In my research on what separates top-performing leaders from average ones, I found something that surprised everyone, including me. It wasn't IQ, it wasn't technical skill, it was emotional intelligence, self-awareness, empathy, the ability to read a room, manage your own reactions, and build trust with people who don't report to you. In a study of over 500 organizations, the competencies that distinguish star performers from average ones were emotional competencies, by a ratio of roughly 2 to 1. Now the room shifts. A different set of heads is nodding. Taylor straightens. Competencies are lovely, but competencies don't ship products. I've watched organizations spend millions on leadership retreats and team-building exercises while their production lines rusted. Here's what I know. When you can measure work, you can improve it. When you can't measure it, you tell stories about it. Emotional intelligence can't be audited. It can't be benchmarked. You can't put it in a spec sheet or a quality standard. And in a world where AI is automating more tasks every quarter, the workers who survive will be the ones whose skills are specific, technical, and irreplaceable, not the ones who are good at reading body language. That's exactly backwards. Goleman uncrosses his arms now. The tasks AI automates first are the technical ones, the ones with clear inputs, clear outputs, and clear procedures, data entry, code generation, financial reconciliation. The skills that survive automation are the ones machines can't replicate. Negotiation, conflict resolution, creative collaboration, the ability to motivate a team through uncertainty. You're telling people to double down on the very skills that are most vulnerable to displacement. Silence for a moment, not empty, taut. Taylor leans forward. You're romanticizing ambiguity. Yes, AI handles routine tasks, but who builds the AI? Who designs the systems that deploy it? Who debugs the model when it hallucinates? Technical skill isn't disappearing, it's ascending. The premium on people who can architect, engineer, and validate is higher than it's ever been. You don't need empathy to fix a broken algorithm. You need math. You don't need empathy to fix the algorithm, Goleman agrees. You need empathy to figure out why the team that built it didn't catch the error in the first place. You need self-awareness to recognize that the reason the deployment failed wasn't a code bug. It was a communication breakdown between engineering and product. 87% of workplace failures aren't technical failures. They're interpersonal ones. Missed signals, unspoken disagreements, teams where people don't feel safe enough to say, I think we're building the wrong thing. A murmur from the back. That number found a nerve. Taylor shakes his head slowly. Safety, comfort, psychological permission. These are the words of people who've never had to meet a production deadline with a margin that doesn't forgive error. I'm not against kindness. I'm against the idea that kindness is a job skill. The workplace isn't a therapy session. It's a system designed to produce outcomes. And the people who produce the most measurable outcomes are the ones who master the hard skills required by their role, not the ones who master the art of being likable. Fred, Goleman's voice drops half a register. Google ran a multi-year internal study called Project Aristotle to figure out what made their best teams work. They looked at hundreds of teams across the company. You know what they found? The number one predictor of team performance wasn't technical ability. It wasn't who had the best credentials or the most patents. It was psychological safety, the belief that you won't be punished for speaking up. That's not soft. That's structural. That's the foundation the technical work sits on. Without it, the shovel doesn't get picked up at all. Now the room is still. Both men can feel the weight of it. Taylor speaks last, and he doesn't raise his voice. I built a system that quadrupled output with the same workers. That system required measurement, training, and discipline. It required knowing exactly how much iron a man could carry and exactly how long he could carry it before he needed to rest. That's not cold. That's respect for the limits of the human body. That's precision applied to labor. And precision, real precision, requires hard skills. And I studied what happens when that system ignores the human being inside it, Goleman replies. The Bethlehem steel workers didn't rebel because the system was wrong. They rebelled because nobody asked them what they thought. The efficiency was real, but so was the resentment, and resentment is the most expensive line item no spreadsheet ever captures. Neither man moves. Here's what Taylor was really arguing. The workplace is a machine, and machines require specification. Without technical mastery, you can't build anything worth leading. Hard skills aren't a starting point, they're the point. And here's what Goleman was really arguing. The workplace is a network of humans, and humans require trust. Without interpersonal intelligence, technical mastery stalls at the individual level and never scales. Soft skills aren't decoration, they're infrastructure. They weren't having the same debate. Taylor was asking, how do you make the work better? Goleman was asking, how do you make the workers better? One optimizes the system, the other optimizes the people inside it. And the uncomfortable truth is that every great organization needs both, but can rarely hold both in focus at the same time. The practical consequence is this. If you're building your career, don't pick a side. Pick a sequence. Master the hard skill first. Earn the credibility. Then develop the soft skill. Earn the trust. Because credibility without trust gets you promoted once. Trust without credibility gets you liked. But both together, that's how you build something that lasts longer than your last performance review. And that is the greater debate.
Let's invent again. There's a question underneath every measurement you've ever trusted. How do you know the instrument is right? In the 1880s, electrical engineering was booming. Edison's incandescent lamp was spreading. Dynamos were powering factories. Telegraph networks spanned continents. But there was a problem nobody wanted to talk about. If you bought a voltmeter from one manufacturer and compared it to a voltmeter from another, you'd get different readings. Not slightly different, meaningfully different. There was no agreed-upon standard for what a volt actually was. Not in practice, not in any instrument you could hold in your hand. Enter Edward Weston. Born in 1850 in Oswestry, a small town on the Welsh border, Weston emigrated to the United States at 21 with a chemistry background and an obsession with precision. He started in electroplating, specifically nickel plating, and within 4 years he'd raised the efficiency of the process from 5% to over 90%. That wasn't an incremental improvement. It was a reinvention. And it made him restless. Electroplating required a constant source of current, so Weston started designing dynamos. Then he realized the dynamos themselves needed better instruments to measure what they were producing, and the instruments didn't exist. Not at the standard he wanted. In 1884, Weston made the discovery that would define his career. He identified a set of metal alloys with extraordinarily stable electrical resistance, alloys whose properties didn't drift with temperature, humidity, or time. These became the foundation for the first truly portable, truly accurate voltmeters and ammeters. In 1888, he founded the Weston Electrical Instrument Corporation in Newark, New Jersey. The company became the gold standard, literally, for measurement equipment worldwide. But the invention that matters most came in 1893, the Weston Standard Cell. It was an electrochemical cell, cadmium amalgam on one side, pure mercury on the other, with a saturated cadmium sulfate solution as the electrolyte. It produced exactly 1.0183 volts, not approximately, exactly. And it held that voltage with a stability no other reference source could match. Previous standards required obsessive temperature control and constant recalibration. The Weston cell just worked. In 1911, the Weston cell was adopted as the international standard for electromotive force. Every voltmeter in every lab in every country was calibrated against it. Every measurement of electrical potential, from industrial power systems to telegraph circuits to the earliest radio transmitters, traced its authority back to a device sitting in an H-shaped glass vessel on a bench in Newark. And here's the part that never makes the headlines. Weston waived his patent rights on the standard cell. He didn't license it. He didn't restrict it. He gave it away. He understood that a standard only works if everyone can use it, and that the value of precision isn't captured by the person who makes the ruler, it's captured by everyone who measures with it. Edward Weston accumulated over 300 patents in his lifetime. He helped found what became the New Jersey Institute of Technology. He won the Lammy Medal. But his legacy isn't a company or an award. It's the idea that measurement itself is an infrastructure, and that the person who builds it serves the entire system, not just themselves. The Weston cell remained the international voltage standard for 79 years, until it was finally superseded by the Josephson voltage standard in 1990, a quantum mechanical device that defines voltage in terms of fundamental constants. Even then, the principle was the same one Weston established. Trust begins with a reference point everyone agrees on. In an episode about flaws, signals, and the things hiding underneath the surface, that might be the most important insight of all. Before you can identify what's broken, you need a standard for what isn't. Before you can spot the deviation, you need to know what normal looks like. Edward Weston didn't just build instruments. He built the trust that made every other instrument useful. And he gave that trust away for free. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc. From electrons that flow like water in Bangalore to a voltage standard forged in Newark, from solar cells that thrive on their flaws to a workplace debate about what's hard and what's soft, and from a single sentence that moved the oil market to the quiet man who gave the world a way to measure anything at all. The pattern was simple. Flaws reveal structure. Because first principles are rarely flashy, but they are usually where the future first becomes visible.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Until next time, stay curious.
Stay kind.
And keep compounding.